Hello, viewers. Welcome to BQ Prime. This is Rishabh Bhatnagar, and you're watching Startup Street. Today, we have with us Barath Shankar Subramanian. He's a partner at Accel, which is one of the very large VC funds out there. Accel is backed among very big global tech names, Meta, Slack, Dropbox. Many of you might have heard of all of them. In India, they've backed Swiggy, they've backed Urban Company, Browser Stack, among I don't know, plenty others. So Bharat today is focused a bit on consumer healthcare and on the SaaS side of things. But today he's here to have a conversation about Accel in India and also a general chat about the Indian startup ecosystem. So Bharat, welcome to BQ Prime. Thanks so much.
Thanks, Rishabh. Pleasure to be here.
All right, lovely. So just to start us off, for our viewers, Bharat, could you describe a bit about what your current portfolio looks like in India? And also, okay, let's just start us off.
Sorry?
If you could just start us off by telling a bit about your current portfolio, what it's looking like currently. What shape is it in?
Right. So in India, we've now been active for over 15 years. We've done over 250 investments till date across 7 funds. So we're currently investing out of our 7th fund. This includes investments across sectors like consumer, B2B marketplaces, SaaS, fintech, healthcare, and more recently we are doing double clicks on some of these sectors, going deep. So I'm spending time on a sector, a segment that we call Industry 5.0, for example. We've done a bunch of investments in the space. Some of them would be companies like Zetwork, Inframarket, Captain Fresh, Bizongo, Detect, Ripic, amongst others, right?
Right.
And then a couple of years back, we launched a program called Atoms. Right? So this is a program to support entrepreneurs who are building at a very early stage. So historically, our focus has been, early stage first. We always aim to be that first institutional partner to anybody looking at, building companies out of India. And Atoms sort of further builds on that, where, essentially we bring in a community-led approach, which is access to mentors, advisors, industry experts, and we've done 20 plus investments through the Atoms program.
Right. Very interesting there, Bharat. My next question would be a bit on what are some of the conversations that you as an investor are having with founders. Let's break it into 2 parts. Founders that still haven't found a product market fit, that are still very early stage in that sense. And second, founders that are generating some sort of cash, but profitability is not in sight. So what sort of conversations are you having given the current environment there is?
Right. See, for the pre-PMF companies, right? Like I spoke about Atoms, it's a perfect fit, and it's we've done this even before we launched Atoms, right? Like a lot of the companies that we invested that have gone on to now become large companies, they were 2-3 member teams, probably an idea on paper, very little early traction, so not even like a product fully built out. In those cases, it's really spending time with the founders, understanding the vision for what they're building, and really drawing a path along with them to say, how do you sort of get to those milestones, right? So how do you get that first customer? How do you then figure out a replicable way to get to the next 10 customers, right? Is there some repeatability in that process, right? And then once you get to that 10 customers, can you now scale it to 100 customers, right? So what does that product look like? In the initial phases, it's going to be a lot of customization, listening to customers, tweaking it, right? But once you get to a certain scale, then what you want to anchor on is the repeatability part, right? You don't want to customize it too much. You want to see if it's able to sort of scale in that shape or form. Right? So that's usually the conversation, and depending on which industry they're building in, there's sectoral nuances to how we do that. On the second question around where there is product market fit and where there is burn, and there it's really a question to what does profitability at end state look like, right? So typically it'll come down to two things. So one is, what are the margins in that business, and what's the cash flow cycles going to look like, right? So those are really the two things that matter. And then how do you get to either of those or both of those at steady state, right? How much capital is it going to take? What will that journey look like? What are some of the known risks? What might be some of the unknown risks in getting there in that journey?
Right. Given the current sort of funding environment, I wouldn't call it a winter, but still, given the sort of tighter access to capital, do you think there is a definite shortening of these timelines in terms of A, finding PMF, and then B, heading towards profitability? Have these timelines shortened because access has become sort of tighter?
Yeah, I think if you look at what's happening, right? So the cost of capital has like gone up significantly in the last 2-3 years, right? So and this is here to stay. So which means anybody starting out here has to fundamentally look at building a strong and resilient business, which probably has a shorter path to profitability than it was, say, a decade back, when access to cheap capital was more prevalent, right? So
Right.
if you were thinking about getting to profitability in 5 years, you probably have to shrink that down to maybe half the time, right? Or cut down the business burn and get to like contribution level profitability in a shorter time frame. So I think that is here to stay, and I think the ecosystem is also internalizing that quite well, in my view. So that's a conversation that we are having with folks that come in and talk to us, new investments that we're seeing, as well as our own portfolio, right? Many of our scale companies are headed in that direction or already there.
Right. I mean, yeah, I'm sure founders themselves would also be including a lot of stress on this in their pitch decks whenever they come to you.
Yeah, I mean, it's part of the conversation, right? It's definitely top of mind for everybody, because one, the amount of capital in the system has definitely sort of shrunk. Not the dry powder in the system, but what is actually being deployed has definitely shrunk in the last 2-3 years. So this tightening means that you as a founder have to be very real about what is out there and how you're going to use that resource to build your company.
Right. Bharat, there have been several instances of corporate misgovernance that have sort of popped up over the last 6 to 7 months, let's say. Is it because there is a mismatch in terms of a realization that there is probably not that big a market of paying users than was previously estimated?
See, I think my view on this part is, depending on which sector you are in, how you had estimated the market versus what the reality has been, there might have been some mismatch. But it's also a function of the pace at which some of the rounds happen. When there was excess capital that was available, and maybe some of the milestones that were set were really not realistically achievable, right? So that might force some kind of behavior change, right? So to actually get to those milestones, if at all it's possible. But I think fundamentally, as an ecosystem, there is a lot more awareness. There is a lot more top of mind recall to making sure that these kind of things don't happen, and processes that are being put in place. Also, in general, if you look at the Indian requirements for a startup versus, say, a company that's incorporated in the US, I think the bar is definitely higher, right? So you have statutory audits and internal audits that are being mandated by the government beyond a certain scale, as well as each fund might have its own requirement in terms of how governance is run, right, in these companies. So my guess is you'll start seeing a better sort of board construct happening earlier now, more conversations around formation of the different committees that are required under law, that were usually happening at a much later stage, will start to happen at a slightly earlier stage now.
Right.
And I think
Very
that's
interesting. Okay. Sorry, go on.
No, I was just saying that's overall good for the ecosystem, right? It shows that you're maturing.
Right. Okay, Bharat, coming back to Accel in particular, there have been a few sectors that you spoke that you're double clicking on. Are you bullish on these sectors a bit more than the others? And what would those be?
No, so the way we've run Atoms, right? So the two sectors that I spoke about with respect to Atoms, these are sectors where we think that in the next 10 years or beyond, right, there's a massive tailwinds. So the opportunity to build in these sectors is here and now, right? So which is why we're going like super early in Industry 5.0 and AI, right? Specifically Industry 5.0, which is a cohort that I'm anchoring. We've done about 10 investments in that space already, right? So some of the names that I spoke about earlier. So here we think that the tailwinds are there is this whole global supply chain realignment that's happening, which is net positive for manufacturing in India. This whole China plus one, sort of playing out with respect to India emerging as an alternate place for large scale manufacturing. And because a lot of this manufacturing investment is going to be in greenfield nature, the ability to absorb and try out and implement new digital first solutions is higher, right? And the proxy for that we've seen is with digital transformation spends that are happening from large enterprises in India, which is quite large in tens of billions. So we think that there is a here and now opportunity to transform some of that into product spends. So that's really what we are working on.
Right. Bharat, lastly, if you could sort of summarize how India has been a market for Accel over the past 15 years or so that Accel has been in, and also over the next 5 years if you're looking to raise any new funds. And
Yeah. See, our journey in India, we started out as a $15 million fund, right? And we made like 10 investments. We are now in Fund 7, which is a $650 million fund. So in some ways, fund size, we've grown sort of 65x. And we've seen that correlate with how the ecosystem has grown, right? So in 2005-6 when we started, even doing these 10 investments was quite a struggle because we really had to scout hard to find these entrepreneurs, find ideas, and convince them to take capital, right? Because venture capital was very new at that time. But now, if you sort of roll forward, the ecosystem has gone through a tremendous learning curve. You have scale companies, you have founders, you have L1s, L2s who've seen scale in these companies, who build products, who conceptualize products, and the overall market, domestic market itself has expanded significantly, right? We are a $3 trillion economy. It's a matter of time before we double. A lot of that additional 3 trillion that is going to get added is going to be digital first or digitally influenced, right? And a lot of that is what we are super excited about looking forward. And with respect to this second part of the question around fundraise, the way we are structured, we have 3 early stage vehicles in India, UK, and the Bay Area where we collaborate on ideas. And then we have these global vehicles that can do late stage, and typically these are 2 to 3 year or 4 year cycle times where we raise these funds, right? So there is always sort of availability of capital for interesting ideas, no matter what the stage is. So we've done growth investments in the last 2 years in companies like Amagi, Eruditus, Good Glam company, for example. And then early stage, obviously, we continue to be active. This current fund, which is Fund 7 for us, was raised second quarter of last year. So there's still a lot of dry powder left in that fund.
Got it. Thanks so much, Bharat, for sharing your views here with us. Viewers, this was Barath Shankar Subramanian of Accel. Thanks so much for watching.